Okay, what's going on, everybody? SmartHelpy.com here. I have a huge update for one of the most popular real estate models I've ever done. It's a multifamily real estate acquisition model. So initially, this template was only for one kind of property with one rent roll, and I've expanded it to up to four. I've also improved a lot of the functionality, the formatting, the flow of the model in general. I've added a lot of summaries. Um, so this is just, it's really cool. If you're into real estate, you're investing. I mean, this is probably going to be great for the corporate, um, like a syndicate that's doing lots of deals and has investors and sponsors and all of that. You could also use it for an individual. You can I made it easily turn, like you can turn each deal on or off, so you don't have to go through the whole model and like zero out all the assumptions. If you want to turn one of these off, you just hit off, and you can see if I turn the last three off, I'm only going to see data for like returns data and general data for the first property only, and all the rest are zeroed out. Same with the consolidated will just be for that one. The detail you can see is just for that one. So lots and lots of work to go into this, that went into this. Lots of sanity checks, lots of just really making sure it all is correct. It's all lined up. Um, so the basic flow here is you've got up to four properties you can model. You put in the building name or property name and the address. That will flow through the model accordingly. You can turn each deal on or off with this selector. If you put it off, it'll just not include any of the numbers in any of the um, summary data or any data across the whole model. So very easy. It's nice for the user. They don't have to manually go through and zero everything out if they don't want to. Um, we start up at the top. So net rentable square foot, number of buildings, number of stories, year built, lot size in acres, just some general information about the properties. Then we've got the capital structure. So here's your purchase price, your acquisition price, the capex, if any, percentage of capex is financed. You've got the amount of capex financed, remaining percentage of capex to equity requirement, remaining equity requirement. So essentially, this is the split between financing and equity of the capex. Then you have any pre-purchase fees, and then the financing loan to value, and then the amount financed, and then finally the equity required. So this is the actual cash that needs to be invested in the property, and this will be for each one based on the different assumptions up here. And the financed amount here, which will go into the first loan, which can be interest only for some amount of months, and then you can also have a refi after some time. Now, if you've used this template before, um, well, I used to have these general assumptions in the pro forma. So they were like spread out here, and it was kind of hard. You had to go through, and manually look at it. Now it's on the global input, so you can adjust these numbers here. It will flow through to the rest of the model, and it's much easier. It's more streamlined uh, to play around with it and just adjust the assumptions. So capital structure, acquisition metrics. You got price per unit, cost per square foot, cap rate in year one, um, operating pro forma for the current year for each one. So this is just current data before you change anything or do CapEx and all that stuff, renovations. Debt service coverage, existing numbers, sponsor and investor annualized ROI, equity contribution. So this is where you can define the waterfall structure a bit in how much of the equity that's required is coming from the LP versus the GP. You can adjust that for each deal. You can also adjust the loan rates for each deal, the interest rate, the term for each of these. Now on the actual debt tab, you can determine if it's interest only or not right here for each of these. Payments per year is fixed at 12. Don't change that. Amount financed is just coming from the amount financed above, monthly payment, annual debt service, just a calculation there based on those figures. Then we've got all these assumptions. So if you're going to refi, here's your LTV for the refi, less lender fees. Here's your refi year defined. You can see if I put this for year 4 and I go into property 2, you can see the refi is happening in year 4. If I were to change that, let's say to maybe year 2, all these numbers change. Also, you can see now the refi is over here in year 2. Put it back to 3. And you can see on the detail the proceeds from the refi, the proceeds from the exit here per building type. You can see the net operating income per type, cash flow after debt service and reserves for each building type, and then the final cash flow, and then also the LP and GP cash flows for each building and their resulting internal rate of returns. Here on the consolidated, we also have IRR for the LP and GP for each building or property. We have the total equity invested and total cash returned per property on a consolidated basis. And then we also have the same thing for the LP, total LP equity, total LP cash return, cash on cash return of the whole deal. And same with the GP. So that's the basic structure. Like I already went over this a little bit, but executive summary is going to show all of the properties, however many you've got turned on, will all flow through to here. And also you can see the consolidated LP and GP contributions and distributions. This is just showing, income, expenses, NOI, other cash flow items, and then total cash flow down here. And then here's some checks to make sure the numbers are correct. This should always be 0. We've also got consolidated, so I just went over this, but it's showing by detail the high level items like NOI, cash flow, after debt and reserves. This is all operational. Then we've got other items like refi, exit, total cash flow, and then cash flow for each LP and GP group for each type of each building. Rent rolls. So this is important. So you can define. I expanded this from five bed and bath types to 10. So that's a little bit more friendly to those that might have more slots than 5. You define, the unit counts, rent per month, current. It'll show you the current annual rent, the percentage under market it is. You can enter the market rents here, annual market rents, and then you can also put what you think you're going to increase the current rents to in year 1 of the forecast of the model. And you can define that percentage here. And then you've also got 2 columns here to show you what you're increasing the monthly rent to. So it's going from $449 here to $494, and that's a 10% markup. And then you're increasing it by $45 in this case per unit. And then it's got that for each of the bed bath types. And I've also done that so you've got separate ones for building 1, building 2, building 3, and building 4. And then this all will flow to the pro formas here for P1, 2, 3, and 4. And you can see this is the current, this is what you plan for year 1, and then this is the change from year 1 to 2 to 3 to 4 to 5 if you plan on raising rents over time. You've also got some other income, ancillary income items up to 4 you can define, and that will flow through. You've got vacancy loss defined here, credit loss, loss to lease, percentage, effective gross income. Then you've got all your operating expenses. This is driven by unit, cost per unit. You've got a management fee in here. We've got payroll, admin, utilities. Utilities can be defined here, and then this will start to increase by this percentage for all expenses. We've got down here real estate taxes, property insurance, total expenses, net operating income, debt service, total debt service, net cash flow after debt service. Then you've got reserves, net cash flow after debt and reserves, return on equity in each period. Then you can also define a fractional amount of the LP investment if you want. So you got the whole LP pool, whatever that might be, and then you can say, well, what if someone invests X dollars in that LP pool? They can put that here. It gives them your share, and then I highlighted in blue text what those returns would look like for that smaller investment in the LP pool if it's relevant. If it's not relevant, again, you can just hide these rows, no problem. It'll show the full investor LP, right here on top of uh, these blue text cells. And then you got sponsor here. This is the exit assumptions. So you've got exit cap, exit value, or sorry, exit cap for the refi, exit value refi, and then here's basically the cash remaining after the refi is done. So you get the loan, you repay the other one, you have possibly fees, and then you could have distributable cash flow here. And then we have exit, and this shows the exit value across year 1 to 10, but it's actually only going to flow to the model in the exit year, whatever that is defined as. So if I were to go to property 1 here and put the exit year at 9 or 8, we can see here this happens at 8. All the cash flows stop after 8. And then we have down here final cash flow split. So this is showing again full investor, fractional investor, total sponsor, the total cash flow per period for each, the cash on cash percentage returned. And this is an aggregate figure based on total cash returned against total investment. Same with sponsor, same deal. Then we also have running balances here. So this is just a cumulative cash amount after all of these assumptions and everything happen. Sponsor, running cash flow, and then IRR of investor and sponsor here. And this is the same for P1 through P4. Debt balances, this is just used as a helper tab to do some of the calculations, but this is essentially showing you the year-end debt balance of each building based on whatever loan assumptions you have. And again, you don't have to have loan assumptions. You could always zero this out. You could say up here 0% is financed, 0% LTV, and that's completely fine. So in that case, you can see now for P1, there's no well, hold on. You also would put refi, you'd go to NA and 0% on that. And then if we go to P1, you can see, okay, yeah, now the refi is zeroed out. The exit is here. There's no debt pay down because there is no debt. And it's just obviously when you don't use any leverage, your total cash return is going to be higher because you don't have the interest, but you also have a higher initial investment. Let's put this back. Put this at year 3. Put it 75%. Here, 75%. And 75. So you can see the equity requirement went down dramatically. Okay, so that's that. We also have so this is the waterfall distribution. It just allows you to define hurdle rates, and up to each internal rate of return achieved by the LP, they'll get different splits. So as the IRR rises for the LP, this is essentially saying they're willing to give up some of the cash flow based on this schedule. And you can define it separately for each deal property. And it just shows you basically tier 1, tier 2, tier 3, and then thereafter the splits. And then you can see this is basically consolidating everything that's happening up here all into one nice easy thing. So you can see here's the contribution row, here's cash flows for tier 1, tier 2, 3, and 4. Okay, visuals, just a nice quick cash flow look at the investor versus the sponsor over the 10-year period for property 1 through 4. Also, you've got consolidated right here. These are all dynamic. And then the debt schedule, we kind of went over this, but you could just basically pick if there's any interest only period, you could define that here, or if it's just straight up P&I right off the bat, that's fine. Just select a 0. You could do that individually for each debt on each of the properties. Refi, you won't do anything on these. These are all automated based on the other assumptions. Okay, so that covers everything. This is really the best, just general use real estate model I've built. I like the flow of it. I like the assumption layout here. I really like the improvements I made to the layouts for these general assumptions. And again, now you can do up to 4. Easily turn things on and off with the selector here. Super valuable, makes it for much quicker analysis. And then you've got these summaries, rent rolls. It's a really great template. So yeah, I'm really happy to do this. I spent a lot of time on this, and I've been meaning to do it for a while, and I knew it's something that was gonna take me a very long time um, to do. So for me, I'm just happy that this is completed. And I can update it across all the sites. We'll get everything going tonight, so it'll be ready to go. I'll include it in the real estate bundle as well, which has mobile home park models, mixed use, self-storage. It has some short-term rental, all those kinds of things. For right now, the price on that bundle is $310. The price on this right now is $75 for just this template. Uh, Description box below will have the link to purchase, or if you're on a vendor site, you can buy it right there. Um, and I'll see you guys on the next one. Don't forget to like the video, subscribe.